Now, as broadcast earlier, the central bank has increased the repo rate by 25 basis points to 7% in order to continue anchoring inflation expectations and to safeguard the peg arrangement with the South African rand. For an in-depth analysis, I'm joined by local economist Robert McGregor from Cirrus Capital. Very good evening to you, Mr. McGregor, and welcome to the Daily Roundup.
Good evening, and thanks for having me.
Well, we've seen increases in the repo rate over the past year. What can we expect in the second quarter of the year?
What we're seeing from market expectations at the moment is that given inflation slowing over the last few months, the views are that central banks globally will be hiking less aggressively. So in other words, the increases that we see from central banks won't be as large as they have been over the last couple of months. At this stage, the expectations are for another 50 basis points worth of hikes, so another two hikes of 25 basis points each, hike peaking in the middle point of this year, and then from later this year, the potential for rate cuts, if not late this year, then early next year. In the global market, cuts more towards the start of next year, but in the domestic and regional markets, so South Africa and Namibia, the market is expecting rate cuts in the second half of this year.
Now, Namibia has not increased the rate at the same level as South Africa. Instead, it has gone a bit lower. What implication can this have for the Namibian economy and in terms of its competitiveness?
So the impact is not so much on its competitiveness, and that's not really the driving consideration. So theoretically, to maintain the currency peg, we can't deviate to the downside from South African monetary policy. That means that we need to be at the same level as them or higher. We can withstand a slight deviation for some period, but not too extreme or for too long. And so the reason why the Bank of Namibia's MPC most likely decided not to hike to the same extent in November last year was simply the impact that it has on households and economic growth from the demand perspective. So the very sharp increases in the interest rates last year obviously having a substantial negative impact on household spending and their disposable incomes. And for this reason, rather the Bank of Namibia viewing the SARB's very aggressive hikes as a bit too extreme and looking to move slightly less aggressively. However, with the sort of relatively better economic outlook in Namibia and the softer increases going forward, it looks like we will most likely stick with the SARB's current hike strategy.
So the steep increases since April last year have hit mortgage holders and debtors very hard. Is there nothing that can be done to alleviate the financial pressure on these groups?
Well, that's particularly why we have seen the central bank less willing and less eager to hike in Namibia, as is the case in South Africa. Unfortunately, this is very much been driven by what we're seeing globally, with extreme hawkishness in the US in particular, and then obviously the Reserve Bank in South Africa, given its inflation targeting mandate, hiking aggressively to match that, protect the rand as well. So at this stage, it's very difficult to do. This is why it's also in general very important to be careful with debt. Debt might seem easy and affordable when interest rates are low, but we know, as we've seen now, interest rates don't stay low forever, and so it's always something to bear in mind.
So we can then expect the repo rate to ease or even drop for that matter?
Yes, so at this stage, the market is expecting that there will be two more small hikes of 25 basis points each up until the start of this year. But at this stage, given growth concerns, particularly in the developed world, so the US, and then also in South Africa, the market is expecting rates to end the year in South Africa and therefore likely Namibia as well. If not at current levels, then at least somewhat lower than what they are now. So some hikes in the near term, but towards the end of the year, the market is anticipating some rate cuts.
Could you perhaps explain to us why there is such a big margin between the repo rate and the interest rate that is charged by banks?
Well, quite simply, I mean, banks typically center their lending around what we refer to as the prime rate. In Namibia, there is a fixed relationship between the prime rate and the repo rate. So there's a fixed spread of about 375 basis points between what the banks can lend at from the central bank and then what they lend out at to individuals, whether it's households, individuals, or businesses. At the moment, I mean, there needs to be some spread there. There needs to be some difference for the banks, obviously, because they need to borrow money from somewhere in order to lend some of that out. That's effectively how the banking system works. If they're doing it at the same rate at which they're borrowing the money, obviously they're not making a profit. They're taking on a risk to do this. And so it doesn't make sense for them to do that. In other countries, we see that there isn't a fixed difference between the repo rate and the prime rate, but they do tend to move in the same direction. In Namibia, it's currently fixed at that difference. There have been considerations about changing it, but that does require a lot more research to see what the impact would be. Just because we may no longer fix that difference doesn't necessarily mean that it would come down. It could also, in some instances, increase beyond the current level. So it's something that needs to be considered, but it needs some in-depth research to really consider what the best step forward is.
Well, Mr. McGregor, let me thank you so much for speaking to us this evening.
Thanks for having me.
That's, of course, economist at Cirrus Capital speaking to us. That's Robert McGregor, of course, helping us to understand how the repo rate affects you and I. Well, we'll be back again just after this short break.